Good afternoon, everybody. Brian Lockett here with Comprehensive Wealth Management. Today, I want to take you through a quick recap of the market outlook event we just did with BlackRock funds. BlackRock was kind enough to fly out one of their chartered financial analysts, Megan Colarusso, to team up with our Chief Investment Officer, Morgan Arford, to take us through their perspectives on the market. I would say that the theme that really came out of both sides is that the odds of a soft landing have gone way up. Going around CWM's factor wheel, what we would describe it right now is that we've been downgraded from a hurricane warning, that's what we had the last time we did this, to a tropical storm. So by no means are we out of the woods, but things are definitely trending in the right direction, and direction matters. So looking at the economy, we would describe the economy as improving. It's not great yet, but it's, again, heading in the right direction. For example, you can see here that manufacturing appears to have bottomed because it really gone into contraction territory, but you can see it's just starting to tick up there, and services has really bounced. So that's a really, really good sign. In addition, something that BlackRock brought to light is that we are seeing steel and coal demand really rising. So this is a sign of productivity, and freight activity is rising as well. All signs that productivity, demand for goods and services is increasing, not decreasing. So that's headed in the right direction, that being not a recession. And financial conditions are very, very loose right now. Again, this is another good sign. Banks are lending, the Fed is keeping things loose, they feel confident about what's going on in the economy, so things again are heading in the right direction. Market momentum, we would say this is positive. In fact, all three, short, medium, and long term, are all trending up. This has a very good psychological impact on the market. Interest rates, we're finally getting some relief here. You know, we saw that shock and awe campaign in 2022 when the Fed had to raise interest rates faster than they've ever raised interest rates before. This really hurt the banking sector for a while. We saw some banks fail, but inflation topped out in June 30th of 2022. I think it was 9.1% at the very tippy top. But as you can see, the white line there, overall inflation has been trending down consistently for a while. So the Federal Reserve is finally giving us some relief, and they have begun to cut interest rates. The Fed funds rate, which is that base rate that everything else is based on with respect to at least short-term interest rates, they cut 0.5% in September. They just cut another 1/4 point last week, expected to cut another 1/4 point here in December. So we're getting relief, but only on the short end, that being home equity lines and auto loans and credit cards. The longer term stuff like mortgages, unfortunately, mortgages have trended in the opposite direction. Kind of surprised by that. You're looking at the 30-year fixed mortgage out around 7%, unfortunately. Hopefully we start to see some relief in that area eventually as well, but unfortunately we're not seeing that yet. Another positive sign is when the Fed did cut short-term interest rates, that brought that 3-month Treasury interest rate down below the 10-year, which caused that uninversion. You've heard us talk about the inverted yield curve. This is a big deal. The two relationships you see on the screen, the 10-year 3-month and the 10-year 2-year, when both of these have inverted, meaning the 3-month and the 10-year are paying, the 3-month and the 2-year are paying more than the 10-year, historically, since 1970, that has preceded every single recession in the United States. So that's definitely something we want to give a lot of weight to. Well, we've seen it uninvert, and we still haven't seen a recession. So odds of the soft landing going up. That'll be the second time, maybe the third time, depending on who you talk to in the Fed's history, that they've been able, to pull off a soft landing. But inflation is remaining higher than the Fed's target. So we're probably not going to see interest rate cuts, taking us back down to like COVID levels where we had zero interest rate policy. We're probably going to see a few rate cuts like we've seen already and been done for a while. Of course, the jury's out as to how far they're going to cut rates. But right now, inflation is staying above their 2% target. Looking at investor behavior, we would describe investor behavior as greedy right now. Everybody's on one side of the trade, that being stocks. They've thrown caution to the wind, and historically when that happens, we have a tendency to have a pretty bad stock market, believe it or not. So looking at the Ned Davis Research Crowd Sentiment Poll here, we have a reading at around 74, 73, somewhere in there. And historically, when it's above 66, you can see here pretty low returns in the S&P 500. And this is because of extreme valuation. Historically, when you see extreme greed, you also see extreme valuation. When I have extremely high prices, there's not as lot as upside left, hence why we saw those low returns. It's funny, investors, I love Warren Buffett's quote, the only thing people don't like to buy on sale is stock, right? We love to buy shoes 2 for 1, that's great. But when the market crashes, everyone runs from it. In reality, that's when you should buy. So looking at several different valuation metrics, market cap to GDP, this is our favorite valuation metric here at CWM. This is extreme. Last time we saw it this high was a couple years ago. That was just before the big sell-off in 2022. And then prior to that, going back to 1972, is nowhere close to where we're at right now. Looking at a longer term valuation metric, the Shiller price to earnings ratio, this is based on the S&P 500, but it's cyclically adjusted. Going all the way back to 1880, you can see here there are only 2 other times in history where the market was more expensive. 2 years ago, or I guess 3 years ago, and then the late 90s tech bubble. Not good company. So this is something that gives us caution or gives us concern right now. And looking at lots of other ways to value the market, it doesn't matter how you look at it. Stocks are very expensive right now. And in addition to that, we have just a handful of leaders, 10 companies to be exact, that are carrying, at least in this case, the S&P 500. So we have 500 companies in the S&P 500 index across 11 different sectors, 10 of which are responsible for almost 40% of the entire overall size, total value of the S&P 500 index. This is extreme. We thought it was extreme back here in the late 90s tech bubble when we had the 4 horsemen of the NASDAQ, Dell, Cisco, Intel, and Microsoft. But we have blown the doors off of that. So this is definitely a concern. We call this very narrow leadership. But as long as those companies are doing well, the party should continue. Now, I'm not getting out of here without talking about the election, which was last week. Bottom line is, markets don't care about who is the president. Markets care more about policy. And in fact, I really like BlackRock's chart here, in which was talking about if I was only invested when there was a Democrat in office or a Republican in office, or I just invested regardless of who's in office. So since 2013, if you put $100,000 into the marketplace and you put it in just when Democrats were in office, you have 172,000 10 years later. Only when Republicans are in office, you have 181,000. But if you just left the money in the market the whole time, regardless of who's in office, you have way more money. And the same story is true over the last 70 years. If I had $1,000 in the market and I just rode it the whole way, regardless who's in office, I have 1.58 million versus 50,000 versus 31,000. So bottom line here, the bottom takeaway, because we did definitely get some emails about people concerned about the election outcome, understandably, is markets don't care about who's in office. What markets do care about is policy. So I think the biggest thing is the known on the horizon right now is the Tax Cuts and Jobs Act in 2017 that's set to expire at the end of next year, 2025. That is estimated to be a $3 trillion hit to GDP if it were to expire. In other words, GDP is a measure of all the money spent on goods and services in the United States. If we see a $3 trillion hit to that, what that means is $3 trillion that was going towards future goods and services because of the tax savings is now going to the government in the form of tax revenue. Now, one can argue this is bad because, the economy would grow and this would be good for the market and the economy. But the other side is that we have a spending problem. If you look at the federal budget right now, we have record deficits. We are borrowing $1.9 trillion and growing. In fact, the last stat I saw was we are adding $1 trillion to the national debt about every 90 days. That is not sustainable. To put that in perspective, go back to 2015, we were spending $3.8 trillion versus today $6.8 trillion. We were borrowing $469 billion to make ends meet. Now we're actually borrowing almost $2 trillion and growing. So we have a spending problem. So on one hand, wouldn't be bad to see the tax cuts get extended because I think it would be good for markets and good for the economy, but that's short term. We do have a spending problem. If we don't get this under control, that's the road to ruin. I would say of everything, this is probably the biggest concern, but not yet. So our overall forecast is we're a tropical storm. Again, we've been downgraded from that hurricane warning, so direction does matter. Our biggest concern right now is valuations. They are at nosebleed levels. I think that's the thing that gives us the most caution. What I really liked from BlackRock here was their overall perspective on whether or not we are going to have a recession. Go back to 22, they thought there was about a 40% chance we were going to see a recession. The overall Bloomberg consensus was saying we're going to see about a 65% chance of a recession, and that has come way down in both instances. What BlackRock is basically saying here is that we're going to see GDP growth slow down. So the overall economy is probably going to slow down, but it's not going to crater. We're not going to go into a bad recession. Of course, no one knows that for sure, but this is all stuff heading in the right direction. With those economic indicators trending up, that also bodes well as well. So odds of a soft landing, I think, have gone up, but of course, only time will tell as to whether or not that is in fact the case. I really appreciate you listening today. If you want to learn more, feel free to give us a call, or you can visit us our website. And of course, we'd love to have you sign up for our newsletter. We're always happy to help here at Comprehensive Wealth Management.